Welcome to the Deep Dive.
Hello.
Today we're really digging into Nanox Imaging's recent Q1 2025 earnings call.
Yep, gonna sift through it all.
Exactly. Our goal is to pull out the most important insights, the key info from management and what analysts were asking about.
Think of it as the highlights reel, focused just on what was said on that call.
Right. We'll hit the financials, operations, strategy, targets, basically everything they covered.
Let's do it.
Okay, so first up, the quick financial picture for Q1 2025. They reported a GAAP net loss of $13.2 million.
Okay, and how does that compare to last year?
It's up a bit. The net loss was $12.2 million in Q1 2024, so about $1 million increase in the loss.
And what did they say was driving that?
Management pointed mostly to a $1.1 million increase in the GAAP gross loss.
Gotcha. What about revenue?
Revenue was $2.8 million for the quarter. That's actually a slight tick up from $2.6 million in Q1 last year.
Okay, so revenue up slightly, but the loss widened a bit because of the gross loss. What were those gross loss numbers?
On a GAAP basis, the standard accounting, the gross loss was $3.0 million in Q1 2025.
Compared to
a $2.1 million gross loss in Q1 2024. So that gap widened too.
Right. And they usually give non-GAAP numbers as well, don't they? How did those look?
They did. On non-GAAP, the gross loss for Q1 2025 was smaller, $0.4 million.
But still a loss. How was that last year?
Interestingly, last year, Q1 2024, they actually had a non-GAAP gross profit of $0.6 million.
Ah, okay. So a swing from a small non-GAAP profit to a small non-GAAP loss year over year.
Exactly. And that affects the margin, obviously. The non-GAAP gross margin was about 15% this quarter.
Versus
around 22% in Q1 2024.
Okay. So yeah, on the surface, losses up, margins down year over year. But like you said, there's more to the story than just those headlines.
Definitely. Let's get into the operations and strategy discussion. Their big vision, it's still this end-to-end solution around the Nanox ARC tech, right? Aiming to improve imaging and outcomes.
Right. And they really hammered home how the acquisitions from 2021 fit into this. USARID for tele-radiology and Zebra Medical, which is now Nanox AI.
How are those integrations playing out?
Pretty well, according to the call. They said USARED's revenue has actually doubled since they bought it.
Doubled? Wow.
Yeah. And Nanox AI has gone from basically nothing, pre-revenue, to generating actual growing revenue now.
And does that integration help with the ARC customers?
That's the key point they made. Most Nanox ARC customers are also using their teleradiology services. So it really bumps up the total revenue they get from each customer relationship. It's not just the machine.
That makes sense. It builds a stickier ecosystem. So how are they pushing this whole package commercially? What's the strategy?
It sounds like a few different angles. They've got their own direct sales teams in the US and Europe.
Okay.
They're also doing collaborations, leveraging partners' marketing muscle, and then distributors worldwide, especially now in the EU.
And they mentioned the other revenue streams help fund this push.
Yeah, exactly. The growing revenue from teleradiology and AI helps support these, pretty expensive commercial efforts.
Makes sense. What about the sales pipeline itself? Are people interested?
This was a pretty striking update. They said the sales pipeline has doubled just since January 2025.
Doubled in just a few months.
Yeah, it's now over 1,000 leads that the sales team is working.
1,000 leads. And where are these leads coming from? What kind of places?
Mostly standalone multi-specialty clinics, small, medium-sized ones, and it's global US, Peru, France, Azerbaijan, Hungary, Poland, all over.
That's a significant pipeline build. But leads aren't deployments. How is the actual rollout of the ARC units going?
So they reported over 60 units are now in some stage of implementation or execution. That includes commercial sites, demo units, and ones used for clinical trials.
60 units out there in some form. Are they being used much yet?
For the ones that are operational, they said the average target is 7 scans per day. But they've seen days hitting 11 scans, even 17 scans in some places. So potentially good utilization once things are fully set up.
Did they give a specific target for end-of-year deployments?
Yes. They're aiming for over 100 ARC systems deployed in various stages worldwide by the end of 2025.
Over 100 by year-end.
Though they did add the usual disclaimer, market uncertainties could change that.
Of course. Let's zoom in on the U.S. market. That's obviously critical. Any updates there?
Yeah, they highlighted progress with distributors. Advanced Southern Imaging, ASI, which they mentioned before, is one.
Right.
And they expanded their deal with Swissway. That seems important because Swissway will now handle service and support, plus non-exclusive distribution specifically to government and public health institutions.
Okay, targeting that segment. Any others?
They said negotiations are ongoing with other leading national distributors. So it sounds like more potential partnerships in the works.
Interesting. And there was something new mentioned about workers' compensation.
Yeah, this sounded like a potentially big new initiative. They're finalizing a project for the workers' comp market in the U.S.
How big is that market?
Huge.
Yeah.
Over 100 million covered workers, apparently. The plan is to build a network of imaging centers specifically for this.
Starting small, I assume?
Yeah, 2 or 3 proof of concept sites initially.
Yeah.
If that works out, the collaboration kicks off with agreed rates between $120 and $180 per patient scan.
And that would fall under their services division.
Not exact. Part of Nanox services. Could be a significant new revenue stream if it scales up.
Okay, what about outside the U.S. international progress?
The big news there was securing the CE mark back in February. That's the regulatory approval for Europe.
Right, that opens doors.
Exactly. So now they can ship the ARC and start installations in Europe via their distributors, subject to local approvals in each country, of course.
Any specific countries mentioned?
They said they're working on deploying systems to Greece and Romania, demo units heading there soon, and also prepping demo units for Mexico.
Okay. Let's switch gears slightly to the AI solutions business. Sounded like that had some real momentum.
Absolutely. They used words like tremendous momentum, strong trial data, overwhelming customer feedback.
Strong language.
Yeah. The AI sales pipeline is growing fast, and they feel the whole, AI boom is helping them.
Did they update on that Ezra AI partnership?
They did. They expect Ezra to expand use into dozens of locations and potentially increase the revenue per scan, too, currently around $75 per reading, maybe over $100, with more AI apps integrated.
And other AI efforts?
Engaging with new AI marketplaces, negotiating with several other companies, and they have 3 pilot programs running right now. So lots of activity.
Are they getting validation from, academic centers, too?
Yes, that's crucial for credibility, right?
Yeah.
They mentioned Oxford University hospitals in the UK published trial data and signed a 3-year contract.
Nice.
And also ongoing projects with Duke, UVA Health, and UW Health here in the U.S. using different Nanox AI tools.
Okay, shifting back to the ARC hardware itself. Any regulatory or clinical updates?
Big one on the regulatory side. They got FDA 510K clearance in April for the Nanox ARC X.
The ARC X, that's the newer version.
Yeah, their updated multi-source digital tomosynthesis system. Getting that U.S. clearance is obviously a major step for selling it here.
And clinical trials.
They stressed how important ongoing clinical validation is, drive adoption and change standard practice. They're adding 2 new trial sites in Europe.
Okay.
And they successfully installed an ARC X system at Shamir Hospital in Israel, which is actively scanning patients for their multi-site trial.
Good progress there. And we shouldn't forget the tele-radiology piece, USARID.
Definitely not. It's kind of the backbone, providing the reading services and supporting most ARC customers. It's key to that end-to-end model.
Are they growing that business independently too?
Seems like it. They mentioned a new agreement with a large U.S. company for tele-radiology services for that company's self-insurance program.
Interesting. And what about that second opinion service they offer?
Yeah, that's their direct-to-consumer play. Connects patients with radiologists. It integrates their AI tools.
Is it getting traction?
Generating some revenue, interpreting about 20 scans a month currently. Priced around $300, mostly private pay.
Okay. What about the underlying tech? Any updates on OEM partners or development?
They mentioned active work with OEM partners for components, like Verix delivering tubes for the ARC X, those past inspection, being assembled now.
Good.
And they're looking for other ways to use their X-ray source tech. They highlighted a partnership with Oak Ridge National Labs.
The government lab.
Yeah, U.S. government agency. They're working together to develop novel, compact, mobile X-ray tech. Prototypes are due this summer.
Mobile X-ray. Interesting. Okay, before we get into the financial outlook details, they mentioned a big conference coming up.
Right, RSNA 2025. That's the big radiology show in Chicago, end of November, late December.
And why is that significant for them this year?
It's going to be the first time they present the whole package together. The ARC X machine, the archive radiology services, and the AI solutions. Their full end-to-end vision on display.
Got it. A big showcase moment. Okay, let's circle back and tie all this operational stuff to the financial outlook. We got the Q1 headlines, but let's break down the segments and talk path to profitability.
Okay, quick recap. Q1 revenue up slightly. GAAP loss widened. Non-GAAP gross margin down. Now the segments
Tele-radiology.
still the bright spot financially. Q1 revenue, $2.6 million, up from $2.4 million. Non-GAAP gross profit was $1.0 million, up from $7.9 million.
And the margin there.
Healthy. About 39% non-GAAP gross margin, up from 37% last year, driven by keeping customers, better rates, and more volume.
So that division is solidly profitable on a non-GAAP basis.
Yes, it is. Now, the imaging systems and OEM segment, that includes the RRC stuff.
How would that look?
Revenue was tiny, 33Ks, and the gross loss was significant, $1.6 million GAAP, $1.5 million non-GAAP.
A much bigger loss than last year.
Yeah, last year is around $0.4 million GAAP loss, so $0.3 million non-GAAP. So the costs there are clearly ramping up with manufacturing and deployment efforts.
Makes sense. And the AI solutions segment.
Revenue grew $0.2 million versus $0.1 million last year. So doubling, but from a small base.
Still losing money, though.
Yes. GAAP gross loss, $1.9 million. Non-GAAP gross loss, $0.1 million. Last year, they actually had a tiny non-GAAP gross profit of $29K. So suggests they're investing heavily in scaling AI right now.
Okay. What about operating expenses overall? Any big moves?
Pretty stable, actually. R&D was down slightly to $5 million. Sales and marketing up just a tiny bit to $0.9 million.
And G&A, general and administrative?
Also up just slightly, $5.1 million from $5 million, mainly due to hiring for the U.S. rollout, IT costs, things like that, offset a bit by lower legal and insurance costs.
All right. And the all-important cash position, how much runway do they have?
As of March 31st, they had about $72.9 million in cash, equivalents, and marketable securities.
Okay. Any significant debt?
A small short-term bank loan, $3.1 million, and about $45 million in property and equipment, roughly 53.8 million shares outstanding.
So decent cash, but that net loss means burn rate is a key watch item.
Absolutely. Funding the scale-up is critical.
Which brings us to profitability. Did they give any timelines for break-even?
Yes, they did. Clear targets based on current expectations.
Okay.
Tele-radiology, already profitable non-GAAP. They expect the AI business to hit break-even sometime in 2026.
2026 for AI and the main ARC business.
The target is 2027 for ARC break-even.
2027. Did they say how many machines that might take?
They gave a range, maybe 1,500 to 2,000 deployed units needed.
1,500 to 2,000.
But it really depends on the mix of revenue from those units.
Meaning CapEx sales versus service agreements?
Exactly. CapEx sales, hybrid models, or managed service agreements, MSAs. It's that MSAs tend to bring in higher hardware and AI revenue per unit over time. So the mix really matters for hitting that break-even number.
Okay. When do they think we'll start seeing a real pickup in revenue from these deployments? An inflection point.
They pointed to the second half of 2025.
Later this year.
Yeah. They expect to see, quote, a lot of the results from all the building blocks they were putting in place, the sales team, marketing, that workers' comp project, partners, international expansion.
Got it. Now, there was an interesting exchange with an analyst on the call, right, about the pace of placement.
Yes. The analyst noted that while the tech seems to be working, that 7 scans per day average is decent, the actual net increase in placements in Q1 seemed kind of low, maybe 10, 15 units added.
Based on the 60-plus total versus maybe 50 before.
Right. And the analyst's point was basically at that rate, getting to 1,500 or 2,000 units for break even, well, it's going to take a while.
How did management counter that?
Their response was pretty broad. They acknowledged, introducing disruptive tech is hard, takes education, support, but they argued, you need to look at the total progress technology, FDA clearance, AI, services, clinical data, partners, the whole end-to-end thing, cost management. They framed it as delivering on their promises across the board.
Even if unit placements are gradual initially?
Right. And they explained why revenue doesn't just switch on immediately when a unit is deployed. There's lag time for state registration, permits, setup.
And critically,
getting the approved explanations of benefits, the EOBs, from insurance payers.
Yeah.
Until you have those confirmations that procedures will be paid for, scanning volume doesn't usually ramp up consistently.
But once they get those EOBs...
They said they do see a mini inflection point at those specific sites where scan numbers jump significantly.
Okay, that makes sense. It's a process. All right, let's move into our This Is Not Financial Advice segment.
Yes, the very important disclaimer time. Everything we've talked about comes only from the Nanox Q1 2025 earnings call.
Absolutely. This next bit is purely exploring a hypothetical scenario based only on that call info. It is not a recommendation to buy, sell, or hold anything. Seriously.
Think of it as a thought experiment. Management laid out targets. AI break-even 2026, ARC break-even 2027, needing maybe 1,500, 2,000 units, depending on mix.
So here's the outrageous but plausible idea, again, purely hypothetical. What if? What if you took management at their word, assumed maximum optimism?
Okay.
Imagine they hit the 100-plus deployments this year, and they successfully ramp that pace significantly, and they nail the execution on scan volume and getting those payer approvals, and they actually hit the 2026 AI and 2027 ARC break-even targets.
It's a lot of hands. A lot of things have to go perfectly right.
Exactly. That's the outrageous part, the huge execution risk, market challenges, timing uncertainty. But the plausible part, if you believe all that could happen based on the call,
is that hitting those profitability milestones would likely change the whole narrative around the company, right? Its valuation could look very different if they prove the model scales and becomes profitable.
Precisely. It's about a potential transformation if the plan unfolds as they hope. But the if is massive.
Absolutely massive. And again, just exploring a scenario based on the call narrative, not predicting anything or advising anyone.
Couldn't stress that enough. So let's wrap up this deep dive. Key takeaways from the call.
Nanox is pushing ahead on multiple fronts. Technology, regulatory wins, like the ARC X clearance, growing that sales pipeline substantially, getting more units deployed.
And that's all supported by the profitable tele-radiology business and the growing, though not yet profitable, AI segment.
Right. Financially, still loss-making overall, but they've now put dates on their break-even targets. 2026 for AI, 2027 for the core ARC business, contingent on scale and mix, of course.
And one last time, this discussion, based only on the earnings call content. It is not financial advice.
Not financial advice.
Okay, so here's the final thought for you, the listener, to consider. You've heard the progress they reported, the ambitious timelines they've set. How do you weigh that against the very real challenges? Disrupting medical imaging isn't easy, and executing these plans takes a lot of capital. How do you evaluate their path forward from here?